He's a famed economist and the editor of the newsletter Gold Stock Analyst, which features his top gold stocks. John Doody joins us today on Kitco News to talk mining stocks. John, good to see you again.
Nice to see you, Daniela.
Well, I want to start by looking at the landscape for mining. You run a top 10 list. Many are based in Canada, so the strength of the U.S. dollar is helping their case. But given how a lot of companies are suffering, are you surprised we haven't seen more M&A activity here?
We could always see more, and I think we're going to see more. One of our top 10 stocks, Remarco, just got taken out by Oceana Gold. Really, it was a big surprise to me. I thought there were others that were more interested. But in any case, it went out at a 70% premium, and I think there's still more deals to come. These companies, it takes two to tango in the M&A business, and a lot of times the acquiree wants to have an ongoing job or an ongoing situation, and there's a lot of egos in mining, but right. Sometimes the financials overcome all of that.
Well, let's look at one of the majors, Goldcorp. After the Osisko fallout and the fact they now have an increased line of credit from $2 to $3 billion, are they in acquisition mode, and who might they go after?
Well, definitely they are. They made a failed bid for Osisko Mining a year ago, and they have a pretty interesting profile about in terms of growth. They're the only major being anybody with more than 2 million ounces a year of production. They're the only major with growth. And in the last 5 years, they've grown from about 2.4 million ounces a year to this year, about 3.5 million ounces a year. But the next 2 years are flat at 3.5 million, and the 2 years beyond that, they're going to slip to about 3.2 million ounces. So they have to maintain that production expansion profile in order to keep the stock price up. It's the most valuable gold stock. It sells for the highest premiums in terms of market cap per ounce of reserves, market cap per ounce of production, and operating cash flow multiple. So if they want to maintain the stock price high, which of course is one of the jobs of management, in my opinion, they're going to have to make a deal, and that's why they tried to buy Osisko last year. And I've got some ideas on who they might go after next.
So, John, are they a buy now?
No, I think the way to play Goldcorp, and I wouldn't mind owning Goldcorp, but the way to play it is buy their target, and you'll end up getting your Goldcorp shares cheaper.
And who do you think they're eyeing? You said you have a few ideas.
Yeah, well, the number one target is in the same neck of the woods as Osisko. It's D.TO. D.TO is a 500,000 ounce a year producer in Ontario, and 15 million ounces of proven and probable reserves, and they've been in a ramp-up mode for the last couple of years. Their ultimate target, maybe reached next year, is 600,000 ounces a year at a cash cost that's average or low, somewhere around in the $600 an ounce range, I think, by next year. And D.TO is it fits all the other criteria. It's in North America. Goldcorp only wants to be in North or South America. They want big mines. They don't want to screw around with 100,000 ounce a year mines, and that checks all the boxes.
So, John, you have a pretty good track record. You have your results audited, up on average 27.3% per year. So what do you look for when choosing companies among over 1,000 publicly traded gold stocks? How do you choose them?
Well, the first filter we put in is either a producer or a near producer. So unless they've got at least a full feasibility study and are in the process of raising money or building a mine, we're not interested in them. I'm not a geologist. I don't know how to read drill results, and so that eliminates over 900 of the 1,000 that you just mentioned. And so within that, we cover 60 mining stocks, and doesn't mean we like them all, but we cover them because what we try to figure out is who's undervalued and who's overvalued in the sector. And you have to have a complete picture of the whole sector to know who fits that criteria. And then from that 60, we pick our top 10 stocks. And the top 10 is really a portfolio that's constructed. It's just not 10 odd stocks. We try to pick stocks that fall into the three classes that we like the best: royalty earners, developers, and growth producers.
Right.
So that rules out exploration and rules out the big majors. And then within that, we try to figure out who's the best buy in each of those sectors.
So, John, with the time we have left, let's get your thoughts on how you see the gold market set up over the next 3 months. Last time we spoke, you said there was a lot of pressure building up on the supply and demand side for gold, which was not yet showing up in the price. How do you see it now?
Well, all the factors are still there, and we get a couple more factors that come in this time of the year. We have the gift season for Christmas, and also the wedding season in India, and those are all demand for gold situations. And we have China is probably going to get their currency is probably going to join the SDRs, and that'll be a long-term plus for Chinese and a long-term negative for the dollar. Central banks won't hold as many dollars, and they'll switch out. So that a weaker dollar is always good for gold. So I think there's some directional good news for gold, but you know, if we ended the year over 1,200, I'd probably be surprised.
All right, John, thanks so much for joining us today.
Okay, thanks for having me.
And thanks for watching this edition of the Gold Report. We'll see you tomorrow.